First of all, you don't think this is a recession now, but you think one is coming by the end of the year. How and why do we get there?
Well, I think the very simple fact is that the Fed wants the unemployment rate to go higher. And so that means even if today's not the day, at some point in the months ahead, we're going to get a negative employment report. And Chair Powell was very clear in Jackson Hole that he has both the will and the means to get inflation down. And to do that, he's going to break the labor market. And I think that's just the simplest way to think about things going forward.
So I made note of that. Apparently he'd said it before, but he certainly made a point of emphasizing it. This idea of there will be some pain for businesses and households. How did you take that to understand how far the Fed is willing to let unemployment rise?
Yeah, I mean, so the first hints came in the June SEP, where they actually forecast a rise in the unemployment rate by 0.5 percentage point. But if you look at where ECI wages are, they're growing 7% annualized. They're just way too fast. And to have any comfort that number is going to come down to something that's more sustainable with a 2% inflation target, they just have to get the unemployment rate, by my estimate, up to something like 5 to 5.5%. And so I think that you're going to see their own estimates drifting higher and higher, and that we will end up in the middle of next year somewhere with an unemployment rate in the 5s, because the Fed has chosen to do that. And we can argue whether or not that's the best policy or not, but we just have to, as investors, accept the fact that that's what they're deciding to do, and it's going to happen. And it's just a question of what level of short-term rates induces that change.
And let me ask one more Fed question before I get to the issue of of investing in that kind of environment there. You see 75 basis points coming in March, or sorry, in September. How far do you think the Fed goes after that?
Yeah, I mean, I think that the most important thing is once they do the 75 basis point hike, they will have the short end of the Treasury curve inverted for the first time. And so Chair Powell introduced this new important idea that having the short run neutral rate, that the Fed funds be above that. And the best way to think about the short term stance of monetary policy is that short end part of the Treasury curve, whether that inverts or not. And right now you have about 50 basis points of steepness in it. And so it will be restrictive after September. And another 50 basis points, 75 basis points after that is going to be enough, in my view, to break the economy. And so I think we top out around 4%. But it's just we don't know for sure, because they'll keep going until they get the result that they want.
So the question is whether or not the market, you think, has priced in this recession you see coming. And then what would investors do in this situation? Is this a get liquid and hang on until the recession is actually priced in?
I think from a long equity standpoint, that's exactly right. And we know the direction of equities. If the economy is going to go into recession, the earnings are going to fall. And right now, investors are seeing very rapid earnings growth because we're in a high nominal GDP economy, and that's going to be coming down. And so, we never know the exact level, but I think the direction is going to be down. Conversely, I think long-term bonds have value. That something a 3.25% 10-year bond, which is giving you over the 10-year period, is going to give you a over 1% real return, is something that is a decent investment.